We start with the second session of the day, which is on SIFs. Given the nascency of this segment itself, we thought it best to have a broader presentation covering it, and then we'll start with the Q&A. For the session, I would like to call on the moderator, Mr. Srivatsan Ramchandran. Srivatsan spearheads the institutional equities business at Avendus Park with 18 years of experience in Indian capital markets. He has held pivotal roles from analyst to head of research to equity sales before being entrusted with the leadership of the entire equity franchise at Avendus. He is an active volunteer at the CFA Society and has been a grader since 2015, a member of the Education Advisory Committee of the CF Institute, and a mentor for the Research Challenge since its inception in India.
For today's session on SIF, we have Mr. Rajesh Bhatia. My engagement and interaction with Rajesh goes back a really long way. I still remember 2007, possibly at Reliance Capital is when the first time I met with Rajesh, and then in Inspired Capital, and then later on in ITI. Just to give some context to the people, he has over 30 years of experience in asset management, and the last slightly over a decade on the alternative investment fund. One of the best long-short fund managers I've known and engaged with quite a few as a part of my career. Professionally, before as taking over as CIO of ITI, he used to be with Sitmo, which was the Tata Investments subsidiary. Before that, Heritage Capital, which was your own shop, if my memory is right. And then before that, Reliance Capital. Over to you, Rajesh. Looking forward to enlightening session. Thanks.
Yeah, hi. Hello, everyone. My name is Rajesh Bhatia. I think I've been very properly introduced. So let's just get to the topic. I'm here to talk to you about specialized investment funds, which is really a new category of funds which are being now introduced by SEBI. It is within the ambit of the mutual fund license that you have, but it provides a certain innovation to what is already available in the mutual fund strategies, and so it adds to a degree of innovation. Let me go to the start of where this is. All right, so like I said, it is a new platform. There is some innovation that is designed. So if you have a mutual fund license, you can then apply for an SIF license, but you have to brand it a little separately because there are some peculiarities to the SIF format, specialized investment fund format, that you should know of. So there is particularly two. One, if you can see that the minimum size of investment that you require to be part of an SIF is 10 lakhs. And the second differentiation relative to other funds that you see is you can naked short up to 25%. Naked short basically means that, let us say I don't own HDFC Bank, and I still short it, which is I sell before I buy it, right? In the anticipation that the price will fall. That was hitherto not allowed in mutual fund format. You could, at best, hedge a position. What a hedging a position would mean is, if you were long HDFC Bank, you could also short an equal amount of, and not more, up to an equal amount of HDFC Bank in the futures market and hedge your position. Balanced advantage funds and arbitrage funds do that, but you could not take naked short. So you could not take advantage of stocks that are declining, right? So India was only in terms of conventional, it's a very conventional long-only market where you could only go long, which is buy first in the anticipation that these prices actually go up. So India is a conventional market, but rightly so. If you look at India over the last 45 years, 50 years, we are one of the best equity markets in the world. The most consistent equity market in the world. Probably we would have compounded at 15%, including 15, 16% for such a long period of time. I can't think of any other market other than the United States which has compounded at such a consistent rate for such a long period of time. Naturally, everybody gravitated towards the long-only side, right? So whether it is AIFs, PMSs, or even mutual funds, everybody has a long-only strategy. But then I think increasingly you want a little more innovation on the fund management side because you also want to diversify your portfolio. You don't want to have all strategies which are extremely correlated to one side of the market, which is a symmetric risk-return profile, right? Long-only funds have a symmetric profile, which is they go up in the market and they go down in the market, right? So when you become richer, what you want is a greater diversification in your portfolio, that products which add to uncorrelation of your portfolio, reduces risk, and still gives you an attractive return. So there is a need that is emerging, given that now we are 50 lakh crore on the equity mutual fund side. There is a need to add a little more innovation, and that's why, very rightly, SEBI has come up with the SIF framework, where you could do a little more, including shorting. But they've made sure that it's only for sophisticated investors, so they've kept a minimum level of 10 lakhs. All right. Coming to SIF. SIF is not a product. SIF is an umbrella. So I want to make that distinction because we have launched an SIF at ITI Mutual Fund, and people start comparing our SIF with, let's say, someone else, SBI, right, Edelweiss, or other. Now, you're comparing apples and oranges. SIF is an umbrella under which you can do equity-oriented strategies, debt-oriented strategies, and hybrid strategies, right? And so SIF is an umbrella where you can have various products. So you have to ask, okay, SIF, but what is the strategy under the SIF? So as we are becoming more familiar with SIF, this is the first distinction I want to make, because SIF products are not comparable unless they are in the same category. Most of the funds that are coming here in the hybrid strategies. And hybrid strategy, the entire endeavor, from whatever I can make out of the products that are coming out, is income generation. So they are a substitute for fixed income, right, or arbitrage fund. So this is where most of the hybrid strategies are coming. We are here, equity long-short fund, right? And by the way, equity long-short investing is a $1.5 trillion market globally. Let me repeat, $1.5 trillion market. The best talent on Wall Street actually goes to managing hedge funds, which is, by the way, a $5 trillion market. And within that $5 trillion market, $1.5 trillion is equity long-short product. In India, it's still taking very baby steps. So this is a huge market with massive talent going in Wall Street to manage long-short. And it's being introduced in the mutual fund format, which is attractive because the taxation in the mutual fund is long-term capital gains and short-term capital gains equity. So that's making this product even more attractive. So I'm going to restrict my conversation today to making you understand this one product, which is equity long-short, where we have had, as an AIF, one of the longest track records in the business. So I have myself been a long-short equity fund manager in India for about 18 years. I think that will make me one of the more experienced long-short equity fund managers in the country. For 7.5 years, we've had that live track record with ITI long-short equity fund. So there's some learnings and the other aspects of purpose, etc., which I want to talk to you about. So I want to talk to you about what we are going to introduce in the SIF and what a long-short equity fund actually means. This is the purpose of a long-short equity fund, asymmetric return profile, right? So like I pointed out, in a long-only funds usually are symmetric, which means markets go up, your funds go up, markets go down, the funds go down, right? But the purpose of a long-short fund is asymmetric return profile, which is you participate on the upside of the equity market, but don't participate on the downside of the equity market. So, for instance, if you notice, Jan 23 to September 24, there was a bull market in India. And the markets went up about 42%, right? A long-short equity fund went up 44%, right? So you participate on the upside. Subsequently, the markets came down, right? Nifty went down by 14%, right? And mid-caps, small caps, I think went down by 20 or 25%, right? But a long-short equity fund, let us say, went down by 3%. What is the cumulative effect of that? The cumulative effect of participating on the upside and not participating on the downside is this. If you can see these numbers, Nifty has gone up 22%, the long short fund has gone up by 40%. 18 percentage points of alpha. Now, you're generating an alpha over the markets with much lower risk and much lower volatility. That's really the purpose. Without an asymmetric return profile, there is no purpose of being in a long-short equity fund. And I'm saying this because India is such a long-only market, people are coming in the long-short equity format, but their returns are very symmetric, just like a long-short equity fund. To me, that serves no purpose at all. It is not adding to your diversification. It is not adding, lowering your risk in the portfolio. So without an asymmetric return profile, there's no purpose of a long-short equity fund, right? So to participate on the upside, but not participate on the downside. What has been the long-term track record of such a strategy? If you can see these circles, this is a 7.5, 8-year-old track record. If you see the circles, these are times when the markets have fallen. Now, each of the times, there is some data that's given here. Each of the times that the market has fallen, a long-short equity fund has protected your downside. Most conspicuous is this 2020. If you all remember, that was a COVID period. Actually, markets fell 38% top to bottom. 38% fall. All your long only fell 38, 40, whatever percent. Long short fund, fortunately, actually made money for you, correct? So you not only protected downside, you actually protected capital. In fact, in this case, you made money. And the cumulative effect of 7.5-year track record is you're compounding at about 14%, and you're beating the market. So you're beating the market with far lower risk and far lower volatility, and you're giving an equity return, and you're actually protecting downside. That is what a long-short product does, and that's how it adds to your portfolio. So now, these are some risk measures. I think all are familiar. You are beating the market with 1/3 the beta. Nifty already is a low beta index. And on that, you're beating the market with 1/3 of the beta. Your Sharpe ratio is, of course, very good, and half of the standard deviation. So for people who, we are in a CFA society, fortunately I'm also a CFA charter holder, we understand these numbers. It's an outcome of what we deliver in the long-short equity format, which is we lower your risk dramatically and yet make you an equity return. Now, some people ask me, do I need a long-short equity product? And I'd say that the need for a long-short equity product has never been greater. Now, if I fortunately we talk to a lot of smart family offices, and they'll tell you that, boss, even if markets go up from here, right, if everything goes right, I'm not going to make more than an 11 or 12% CAGR, given how high the Indian equity valuations are. God forbid, if the market goes down and goes up, my 11-12% CAGR is also a threat. So I'm not comfortable with the valuations of where Indian equities are. Second, by the way, I'm not comfortable with the risks that are emerging in the market. So nobody's comfortable with Trump economics, right? We are going into a multipolar world. Right? Then you have a challenge of, 3 weeks ago, there was a cover story on Economist which said, does the developed world have a debt problem? Right? You've seen how UK has raised taxes, and that has made the owner of ArcelorMittal leave the United Kingdom. They are actually raising taxes, right? Because they are in trouble. They have a massive amount of debt, right? So they concluded that, Economist article concluded that IMF could be required for countries like UK and France. They are in such a bad debt trap that you will actually require IMF to help them. That brings fragility to the global world, right? Then you have a challenge of, is the question being asked, is AI in a bubble, right? So the point is that for $5 trillion NVIDIA valuation, what kind of profits would you need, even to make a 10% return to perpetuity. $500 billion of profits, only for NVIDIA. Well, let me put it in context. The global world economy is $120 trillion. The services economy of the global world is $60 trillion, on which you're hoping that NVIDIA will make, just one company will make $500 billion of profits. So the question is AI in a bubble? And if the mother market collapses, what it does to the global world? Then there's a challenge of supply of paper. As on 31st October, 1,20,000 crores of IPOs have been approved by SEBI, which is going to come up in the next 2 or 3 months. This is over and above the stake sales that take place. So Bharti sold its stake for some, in Bharti Telecom. Singtel will sell. There was a supply of Sagility. There's a supply of 197. Then Swiggy will raise 10,000 crores on QIP. This is over and above all of these IPOs that I'm mentioning. The supply of paper is overwhelming in India. So when you look at sophisticated investors, they're saying, my God, these valuations are not where I want them to be. And there are so many risks to the equity markets, right? What happens if the market, macroeconomic, when do large corrections in Indian markets happen? When there's a macroeconomic imbalance. Go back to 2008, go back to 2013, even 2020. People were worried that there could be a macroeconomic imbalance. Fortunately, we have managed the macroeconomic balance very, very well. But what if there is? There'll be a massive downside to small cap and mid cap stocks, right? And after that also, they will not be cheap. So people are worried about these things, and they're saying, what is my strategy in my portfolio that de-risks me from these activities? So the need for a long-short fund has never been greater than today, given the challenges that the markets are facing. I want to give you 2 more insights into investing that I've learned, right? We've all learned the power of compounding, right? 8th wonder of the world. Every equity investor in India is very familiar with boss compounding, SIP, right? And we love Warren Buffett. Warren Buffett has taught us the power of compounding. But, people don't talk about what is the first principle of Warren Buffett. How many people have been taught what is the first principle of Warren Buffett? It's rule number 1, don't lose money. Rule number 2, never forget rule number 1. Do you know why he says that? And by the way, he's sitting on $380 billion of cash in the sexiest market in the world, United States. Everybody wants to be in on AI. What is he doing? $380 billion in cash. Why? He doesn't want to lose money permanently, right? Seth Klarman, who's written the best book on investing called Margin of Safety, will tell you that if you compound at 15% per annum for 30 years, and on the 31st year, you lose money permanently. Let's say you invest in an NVIDIA or in the AI bubble, and you lose 30-40%. Your 31-year compounding becomes a mediocre 7% per annum. So there is a reason why people say don't lose money. Because it interferes with long-term compounding. It is an essential condition that to compound at an attractive rate over the long term, you need to protect your downside, right? And I've given you this 2 portfolios for comparison. One is typically like a small cap. Let's call it a rabbit. It really moves fast, but it's also volatile. And let's call this a very agile, reasonably agile tortoise, right? So this is like a rabbit versus tortoise race. It moves a little more agile, but doesn't fall as much. Surprise, surprise. In year 3, the second portfolio is ahead, with far lower risk and far lower volatility. So if you talk to any of the long-term investors in America, whether it's Warren Buffett, Seth Klarman, Irving Khan, George Soros, they'll tell you it matters how much you lose, right? Don't lose too much money. So that's one investing insight that I thought, to compound money at an attractive rate for the long term, first rule is don't lose too much money. Don't lose permanent capital. And that can interfere with your long-term compounding. The second insight I want to share with you is, when I talk to people in India, people say 6 months, 1 year of sideways movement. After that, India is going to compound at 15% per annum as it's done over the long term. Now, great. Of course, we all would all love that. But just as a historical context, people who are as old as me would recollect 96 to 2003. Actually, if you take 1992, but that was a mania. Even if you take 1996 to 2003, markets did not make you money. For 7 years, the market was flat. Second, 2008 Jan to actually 2015 Jan, we had given money to a long-only manager, he made 0 return. Now, if you're a 50-year-old, 60-year-old, 70-year-old, 80% of your money is in equity. All equity, 40% of that probably is in mid-cap and small-cap. You're thinking, when I'm 60, 10 years later, I'll compound at 15% per annum. My 5 crore portfolio is going to become 20 crores. That's enough to retire on. What if that 5 crore remains at 5 crores when you're 60? Right? What happens when you don't make money for 10 years? Right? So, do you have a strategy that mitigates your portfolio achievement that you want for later on? But it should still be an attractive return. The answer is a long-short equity fund. So that's the 2 investing insights I wanted to kind of just share with you. I think what I want to tell you is that basically this is some type of a structure of portfolio construct that you can have in the SIF, right? We are, from at least our perspective, we are a fundamental long-short equity product. What we do is, on the long side, is exactly what a long-only fund does. We have equities for the long term, right? So, we've, let's say, invested in something like Bharti for 5 years. We've quintupled our money. 6 months ago, we bought HDFC Bank, right? 5 years ago, I bought SBI Life. It's gone up 3 times for me. We do exactly the same thing. So it's not as if all hedge funds are, or long-short funds are really, changing positions minute to minute. No, not really. We keep our positions for really long term. We are equally long term in our orientation and equally fundamental in our orientation, even more sharper actually. And then we also short, right? So we also short businesses. So let us say if I felt that the MFI space, has got overcrowded and there's too much private equity money which is making all these companies go very, very aggressive. I mean, who wants to lend to somebody who's borrowed from 5 borrowers already? You are the 6th lender to a person, and I don't know what kind of risk management that is, but it happens in business. And of course, the NPS kind of spiked. So let's say if you say, I will short a bank which is massively exposed to this kind of credit cost, damage that can occur. So basically, 2 things that we do. One, we identify companies on the bottom up, right? Long or short side. And second, we navigate the markets, right? So let's say a COVID period takes place, we are closer to this in terms of our exposure to equity. And when Jan 23 to September 24, a bull market takes place, we are closer to this. So we navigate the markets with our equity exposure as well, based on what we see as the market outlook as you move forward. And of course, that's a skill set, to do this. So that's really what we do. And that's what helps us to achieve what we think is the purpose of a long-short equity fund, which is this asymmetric return profile, right? To participate on the upside in the equity markets and not participate on the downside. That provides a diversification to a portfolio. As India gets richer, the need for a product like this, given the context that I just spoke about, the need for that is going up. Let me summarize what I just said. We are in the equity long-short space. There are many types of SIFs. There are hybrids, which are more income-oriented. Ours is a capital appreciation product. We are equity-linked. The purpose of a long-short equity fund is to participate on the upside and not participate on the downside. And there are funds which have proven that over a long period of time that you can do this. And especially in periods like this, 2020, it can become a significant kind of value add to your entire portfolio. And I talked about 2 investing insights. Rule number 1, don't lose money. Rule number 2, never forget rule number 1, because it is an essential condition that if you want to compound money at an attractive rate over the long term, that you should not lose permanent capital. And lastly, please remember, equities don't go only one way up. The last 5 years, 6 years has colored our expectations of equity. it can be a little bit of a volatile asset class. Okay, I'll just stop at that. I think I've summarized what I wanted to say, and thank you for your time.
Thanks, Rajesh, for the introduction and the idea.
Yeah.
I'll just start off with, you've been a long-short fund manager, and most people, including this audience, and we know our industry better, right? Most are long-only bulls.
Yeah.
What are some of the learnings you've had in the last 17, 18 years, which you would be applying to this overall strategy? A little bit more nuanced. What does medium-term, long-term shorting works in India, more tactical shots? Just your thoughts on what would be your framework for this portfolio?
So first, I think the most important thing, if I could communicate to the audience or people who are listening to what is an equity long-short product, is to set the framework of expectations right in what to expect from a long-short equity fund, right? So the purpose of a long-short equity fund is to generate an asymmetric return profile, which means that if a fund manager, when the market goes down, protects your capital, and in a fund manager who, on the upside, if he makes equity money, he's doing his job, right? What tends to happen with a long-short equity fund is people may not necessarily understand the purpose from time to time. So when the markets are going up like a raging bull market, right? So we made 44%. Is that good? Probably good. But it's possible that somebody will say, my small cap fund has done 65%. Now, you just compared an apple with an orange, right? And let's say in the 12 months, the market is down. Markets are down 14 and we are down 3. Somebody will say, I'm not making income on this product. So if there is one thing that if I can communicate to the audience on the long-short product, it is, please, this is a different asset class by itself. And it's meant to give you this type of a return, and it's a separate. So nobody expects equity return from a fixed income portfolio, right? Nobody expects annual income from an equity fund, right? So
I think the market will differ on the second part. Most people are assuming equity to be fixed income, but
correct. So if there is only one thing that I would want to communicate to the audience is, please, this is an asset class by itself, which has an asymmetric return profile. I think you asked me something about shorting.
Yeah.
Okay, see, shorting, again, if you ask a typical long-only manager, they'll say, India mein shorting nahi hota hai, right? It is very difficult to short in India. And by the way, I've been doing it for 18 years, right? Now, as much as, the long-only manager will tell you, even in a declining market, stocks go up. The corollary to that is, even in a rising market, stocks go down. There are some stocks which go down. There's an opportunity to short even there. Now, you look at, we are all informed people. Disruption in businesses, right? How many disruptions are going on in businesses, right? So you see broadcasting. You know the broadcaster that we have, and we thought these guys were like almost an oligopoly, right? Maybe 3-player market,
30p.
Right? 30p, 35p, right? That's what, and where are they now? 10p. Why? Because the eyeballs moved. The eyeballs moved from watching Zee TV or Star TV to watching Instagram, YouTube, so on. And that's where all the advertising dollars moved, right? So can EV disrupt ICE engines? Maybe not here now, 10 years later, right? So there is a lot of disruption that is taking place in the world. And like I said, in MFI, who wants to lend to a sixth borrower? But there are pressures on the financing side that takes place. So from time to time, you get structures of industry which are weaker. I can take advantage of stocks that are declining as well. That's point number one. The second purpose of shorting is you're far more risk aware. So when COVID strikes, if you ask a long-only manager, because he's just wearing a different hat, he would say, what can I do about it? I'll ride the COVID wave. The long-short manager can short to protect your capital. So if you're far more risk aware because it's in your DNA to watch for these large risks which can disproportionately impact markets. So it has two functions which I think are extremely important.
Sure. There's a lot of questions from audience also. I'll
just go ahead.
Mix up both.
Yeah.
What are the market conditions in which the long-short strategy could lag markets? What would be helpful if you could paint a couple of scenarios that it could play out?
No, clearly. I think you'll be, like I said, when there's a raging bull market, not as if the long-short fund will not make equity returns. So let's say even if you make 44% return, there'll be somebody who will say, I'm making 60% somewhere else, right? But that's a different product, and it's particularly more small cap, more mid cap. So to that extent, I think you need to have that, okay, if I have 80 rupees in equity, I can change that 20 rupees, go into a long short equity fund because it provides me with a downside protection, right? Now, let us say, please take a name. Let's say you're Virat Kohli, right? Like, let's say you made some money. Take a number. You made like $500 million, right? You made 4,000 crores, right? Now you're Virat Kohli, you're retiring. Now, Virat Kohli doesn't need 25% per annum. Virat Kohli wants more protection of capital and yet an attractive return, right? So if you tell him as an equity, advisor, sir, the market went down 25%, your 4,000 crores has come to 3,000 crores. You just lost 20, but it'll all come back. Now, it may not be palatable to somebody like that I just lost 1,000 crores, right? That after I've retired. He said, look, boss, just give me a strategy that makes me more than that 5%. I don't want to make inflation returns, right? But I want a strategy which will make me an equity return, but it'll protect my downside. So the answer, as you become richer and richer, why is this a $1.5 trillion market globally? As you become richer and richer, you don't want to run like a rabbit and risk everything. You want to make sure that what you've made, part of that is protected.
Is the investing universe restricted largely to the Nifty 50 names, or is it what is a typical investing universe?
So as far as we are concerned, it's top 250 names. Why? By the way, that's 90% of India's market cap. The large and mid cap space is 90% of India's market cap, and that's plenty.
Okay. The current regime where macro tailwinds, capex revival, domestic liquidity is so strong, what is the conviction for a long short fund?
So,
the recent, what you've been saying, last 6 years.
Yeah, I mean, I think as much as you understand markets, don't forecast. Your allocation, portfolio allocation and portfolio management of your own wealth should not be based on your own forecast. I mean, to some extent, yes, but not totally. I think it should be a little bit diversified out of that. Let me give you an example. I met a CEO of a consumer company in Jan 2020. And he said, it's a damn good time for me to be in small caps, right? And he says, I'm putting my money into small caps. And did he know that COVID is coming in March 2020? He did not. So that small cap portfolio, wherever he put his bulk of his money, would have been down by 40, 50, 60%. And I hope he had the nerve to hold on to that. But what I'm saying is you can't forecast these things. When you are asset allocating to your portfolio, you have to asset allocate based on probably valuations or where the state of the market is, etc. And what is your own risk return tolerance. To answer your question, it's not as if, okay, if the markets are going up now a lot, I will not allocate to a long short. I will do only long only. And by the way, if the market looks toppish, I'll move my money to a long short fund. No, it's an allocation call. Don't make asset allocation calls based on what your forecast is. It should be what your risk return tolerance is and what outcomes you can kind of be comfortable with.
Actually, it's a very interesting question. How does long short performance contrast with long only funds which have downside protection? There are a few mutual funds which have beyond particular multiples, they buy put options.
So I think balanced advantage funds are the more prominent ones. In 2020, your top two balanced advantage funds were down 28% and 24% respectively. Balanced advantage funds have a different mindset. So balanced advantage fund, what they do is that they say, I'm doing asset allocation on your behalf. And when you move from equity to fixed income, you are not going to pay tax. So that's their mandate. So they say, okay, if the markets are overvalued, what I will do is I'll move your equity allocation to 30, right? And increase your fixed income to 70. But 30, not 0, right? And when the markets are overvalued, I'll take it to 60, 70, but not 100, right? So they are doing the job of asset allocation. The equity long short product can go to 0 and 100. So it's a fairly an equity-oriented product where the idea is I will protect your capital. So in 2020, even a balanced advantage fund lost 28% and 24% respectively.
Would a long short equity fund have more acceptance if there's a performance-based fee structure that's allowed by the regulator?
Well, I think it's in favor of the long-short equity fund manager to have, in fact, internationally, that is a practice. They would love to have zero fee structure and based on performance after a hurdle, take away profits, right? That's a cyclical factor, let me tell you. My own experience with investors is when you have done extremely well, they are extremely sour with how much you're taking away and vice versa. So I think you give options to investors and let them decide. By the way, as far as our AIF is concerned, we have both structures.
Okay. On the SIF side, obviously SEBI is
unfortunately, the mutual fund side, you require and it's also, I think, probably the way mutual fund is distributed in the country, etc. There's very little direct, markets. As they evolve, maybe that's something that can be looked at by SEBI.
What market signals or risk parameters guide your decision making in reducing your long short on the short side?
So basically, look, this is a very skill set oriented product. I mean, if you know people in the AIF side on long short equity, I mean, it's like a graveyard. A lot of people have failed in this business, long short equity business. I mean, every brand name has almost failed in the equity long short. Because this is supposed to be done by somebody who's extremely experienced, right? You have to have an understanding of where are we on the market cycle, economic cycle, valuation cycle, and most importantly, the sentiment cycle, right? And that helps you to navigate the markets. As Howard Marks would say in Mastering the Market Cycles, you would know whether we are in an overbought, overvalued market or a cheap and oversold market. That just gives you a sense of how you should be positioning your portfolio. So that's point number one. One is judgment on where are we on the market cycle and understanding our insights on that. Second is that you actually have a process by how you protect downside. Without process, you cannot have consistency. So we have both the layers as we navigate the markets. There's a knowledge layer and there's a process layer, which is why we achieve consistency. But the knowledge layer is even more important, right? And that's a skill set oriented product. You are basically a fundamental trader. So you're doing fundamentals, but you're also trading. So the best interview, if I would tell you, there's a book called Market Wizards, in which they have interviewed a guy called Jim Rogers. And I think it's the best book on, best interview on fundamental trader. Right? So this guy goes and tells Jim Rogers, I want to interview you. I'm interviewing all traders. Jim Rogers says, I'm not a trader, I'm a fundamental guy. He says, but you do short and you do take these kind of positions. So to me, you're a fundamental trader. So that is really what a long short equity fund manager tries to achieve.
Will the growth that you see could potentially happen in SIF start hurting arbitrage funds from a crowding out point of view?
So I would like to believe, and I'm a biased book here, but I'd like to believe this is a very disruptive product. Think about it. If I give you the type of risk return that I've just delivered, right, which is protect your capital and make you equity return, beating return, index beating return. Why would you invest in a long-term fixed income? Why would you invest in private credit funds, which are illiquid? Why would you invest in an arbitrage fund? Why would you invest in a equity saving fund? Why would you invest in a large cap fund? Why would you invest in an ETF? Why would you invest in a balanced advantage fund? The risk return profile of this fund will be far better than all of the names that I mentioned. So to my mind, if executed well, because I told you AIF is a graveyard, this cannot be done very easily. This requires a skill set. So consistency has not been the forte of the AIF business in the equity long short business, right? Which is a separate business from income oriented long short products. So let me just clarify that again. So it can be a massively disruptive product. Let me just give you one more instance. I pointed out, what if there's a macroeconomic incidence? India is so long only in their entire book. Everybody is in equity long only. One macroeconomic imbalance, then you suddenly realize my portfolio is really down by 40%. Where is that strategy which can protect me from these? And by the way, it's still making me an equity return. Suddenly SIFs become the answer, right? Very few people learn a priori.
Yeah.
Most people learn post, right? So I think that is the time when I think there will be a realization, I need something like this in my portfolio.
If you were to wear a factor lens, what factors you think ideally works well on the shorting side?
Well, I think to begin with, at least the way so that's a very interesting question. So look, I've fortunately studied and met some of the so because I used to run an American product, right, for 5 years, American investor product, which invested in India for 5 years. I met several of the long-short equity fund managers. The mistakes that usually long-short equity fund managers make is two things. One is that they short for valuations. So I know a long-short equity fund manager who shorted Netflix or Tesla at around $50 billion. He said these business models just don't make sense. They are too overvalued, right? And of course, those stocks became like $1 trillion, right? So you never short only for valuation. You short for a catalyst. Second is, some of these long-short fund managers are very hard-headed in their, so you stand out when you have a very strong opinion.
Jim
Right?
Chanos.
Right. You stand out when you have a very strong opinion, but they get wedded to that opinion, right? And so I know a fund manager who shorted 2008 because he had a damn good short, and he got renowned. He got so renowned that he kept his short position. And in 2009, he had to short shop, right? So you have to be a little more humble in knowing that the market is, greater than you, and don't get hard-headed. And I know this is a marketing business. The asset gathering business is a marketing business, and it's a brand name business, but don't fall for it, right? And don't allow it to color your portfolio as you're navigating the markets.
How do you see, and you did mention valuation, so I'm just tempted to ask this question. India is known for its frothy valuation on an extended basis, with more active onshore shorters, which historically India has not had, right? We've not had institutional money shorting Indian markets. Is there a hope, not now, at least 2-3 years out, that valuations become a little bit more palatable in this country?
Because of shorting? No, I don't think so. Because, look, I think there's just too much money on the long side relative to the short side, right? So short side, the only thing is, whenever a negative catalyst comes, right, my learning is that in the on the mid-cap and small-cap side, the price is vulnerable to the marginal seller. I own 10,000 shares of a mid-cap company, and I want to get out. I will tell my broker, 5% नीचे डाल के मेरा share निकालो. And the guy who owns 5 lakh shares is not going to buy that incremental 10 lakh because he'll keep getting caught, right? So when the markets decline take place, the marginal seller decides your price. So if there were a macroeconomic imbalance, that's the time you have to kind of worry.
Sure. Last 2 questions. Does SIF allow SLBM-led shorting, or it's only futures that it's used?
So SLBM, honestly, is not a very liquid market. So which is, you borrow stock, which is what is done internationally. Fortunately, India is a very unique, you guys probably should know that India is a futures market where 220 single stock futures get traded. That's not what is done conventionally globally. So India is a fantastic futures market, and that's a very liquid market. So we prefer to be in the liquid market rather than savings and borrowings.
Last question. If you are the SEBI chairman, what would be the changes you would make to make shorting and markets more dynamic and shorting more easy in this market?
Well, I think the SIF could be given more flexibility, but SIF I think they are doing a very responsible job, starting with 25%, because look, it's a skill set based product. If ever there's a worry that I have is there's not enough skill set in SIF, right? So we'll kill the category if we deliver bad returns, right? So let's take a step at a time. Let's do this in a manner where people are happier with the outcomes that they get, even if they are less reasonable, before we kind of become far more dynamic as we move forward. So I think what SEBI is doing is really correct. You want a little bit of innovation because the market is totally aligned to the long side. You want to offer a little more diversification, which is liquid, which is regulated, which is tax efficient. Voila, you have an SIF, right? So it's a fantastic category that the SEBI has come up with. Let's take a step at a time.
Sure. Ladies and gentlemen, with that, we are on time, unless Himanshu, you want to step in and...
Thank you so much for the insightful discussion, Rajesh and Srivatsan. Firstly, a clear disclaimer. All the names or sectors referred to are purely for illustration purposes and does not constitute investment advice. I think the presentation and the conversation overall beautifully delved into the DNA of specialized investment funds, as well as bringing into light the relevancy of the product as a category itself. It outlined the fact that investors can't afford equity, the volatility of equity investing, or the longer periods of low or no market returns. Which kind of Indianizes the first session that we had talking about trying to manage or target the volatility in investing. I now invite Satish Betadpur, CFA, Senior Managing Director and Heads of Investments India at State Street Investment Management, to present a small token of appreciation to our speakers.